history has taught us that corrections are inevitable with silver production to meet demand until next decade. People that are suffering today in Venezuela, they get it. And the only things that have really lagged, there's a new race. The Trump administration in the last 12 months has taken some major unprecedented efforts, and that's going to require a lot of copper. Something like that could curb gold's ascent.
Shawn Khunkhun, President and CEO of Dolly Varden Silver. It is a true pleasure to host you back on Palisades Gold Radio today.
Thank you for having me.
Excellent, Shawn. Really excited for our chat today. We've seen a tremendous increase in volatility in the precious metal sector. I mean, just last Friday, silver traded down from $120 all the way to $75 an ounce. Of course, it has recovered quite a bit already, currently at about $89, $90 an ounce on the 4th of February. However, Shawn, what is going on to the precious metal sector, and what are you making of this increase in volatility in silver specifically?
You know, silver was really in a range for a number of years between $20 and $30. And as it built in that range, it was baffling for a lot of us in the silver industry because we saw on an annual basis more demand than there was supply. And we're not talking about 10 or 20 million ounces. We're talking about 200 million ounces on an annual basis. So, you know, what my experience has taught me is you could be in a structural deficit and it could last for up to 2 years before you see the price react. That's what other commodities have taught me over the last couple of decades. And so, but for silver, it was going on for 4 or 5 years. And finally, in April of 2025, the price broke out and it stayed strong, and we started getting into a period very, very quickly starting in around September where when we blew through $40, you know, the price really never looked back. Now the challenge though, when you put on a move as fast and as dramatic and as strong, history has taught us that corrections are inevitable. So we were in a moment for the last 60 days heading into last Friday where the price was unsustainable. And we could point to, and we can blame the CME for raising margin requirements. We could just talk about the over leverage. We could talk about a more hawkish stance from the Fed. But the reality is, I think the simple answer here is we've had the price go from $40 to $120 in a matter of months, and that's not sustainable.
Yeah, so just a healthy pullback in the bull market, I suppose. Is there still a strong bull case to be made for silver today?
Yes, I do think there is. I think, we're still, none of the challenges that caused the price to surge, we don't have a solution for those. We don't see ourselves getting to a place with silver production to meet demand until next decade. So I don't know how we're going to get through the next 4 years without sustained higher prices for the metal. We on the mining side can't just flip a switch and produce more metal. And on the industrial side, the demands for silver, it was historically, photovoltaics, which is the solar panels. But more recently, the EV market, led by Samsung with the solid state battery, is going to put a huge bid under the silver market for the coming years. And so I think silver prices are going to stay strong and sustained and have the potential to go higher over the next 4 years.
Yeah, some great points there, Shawn. Silver we cannot meet demand until the next decade you're outlining there. Of course, at some point, the price will be high enough to incentivize producers to really ramp up production, even, marginal producers or byproduct producers. So what do you have a feel for what price that would be where you would truly have an incentive to produce significantly more silver than we are doing right now?
Well, the tricky part with silver, and the reason it is, such a challenging metal, is because only 1 out of every 4 ounces comes from a primary mine. And so it's actually, the price could go to 150, 200. You're not going to incentivize a copper miner or a zinc miner or a lead miner who maybe only a third of their deposit or a quarter of their deposit is silver centric. And so this is what made, I think, silver the best investment of our lifetimes. If you go back to the lows we saw in 2020 when the price got smashed temporarily below $12, and it's why myself and others in the mining community were so outspoken about one unusual set of circumstances that led to that, and how historically cheap it was relative to other asset classes. If you go back to that moment, silver to gold was 125 to 1. And so it wouldn't surprise me if that silver to gold ratio normalized to historic levels. And so, that could be 15 to 1, that could be 20 to 1. And so if gold stays elevated, and really silver has always followed gold, what we really need to look at too on Friday's correction is it wasn't a silver correction. Gold was down 9%. And historically, silver has outperformed gold to the upside, but also to the downside. And I think Friday's move was actually more about gold than it was about silver. Silver just took it a little bit harder.
All right. You, of course, also referenced the industrial application earlier, solar panels, now very recently also the solid-state batteries led by Samsung, like you outlined. Of course, at some point for them, the price of silver, oftentimes we hear that it's just a very small component of the unit price. So even if silver were to go up, it doesn't really affect the unit price or the margins that much. But at some point it will, and people will start looking for replacements into other metals as far as that's possible. Do you have a feel for when that point would be? Would that have a significant lid on the silver price as we're seeing right now?
Look, again, depending if you're talking about a $60,000 or $70,000 automobile, and it's still unclear exactly how many ounces is going to be in the solid state battery. There's ranges depending on the manufacturer, but again, I think the experts that I've listened to on that side of the equation, they're talking about prices in that 150 range where you start to look at alternatives. We saw it in the auto industry with catalytic converters when the price of platinum, reached $2,000 an ounce. Car manufacturers looked at palladium as an alternative. So I think that unfortunately for both gold and silver, for things that you can't. That you rely on, things like airbags in vehicles, things that you need to work. There is no substitution.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Gold Corp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. All right, makes complete sense. We also hear reports of a battle between paper markets in the West, the Commodity Exchange in New York, the COMEX, LME, in London, versus physical, where you have Shanghai now a new contender in the exchange world that's predominantly physical. Are you seeing this battle play out as well? And is this significantly driving the silver price additionally?
Yeah, I saw this firsthand in 2020 when I mentioned the silver price getting down to $12. The reality, you couldn't source physical metal for under 18, and if you think about that difference, that's a significant spread on a per ounce basis in percentage terms. So I think we've always had the physical market and the paper market. we are seeing a wider spread today. And I think what's changed is I go back to everything changed in 2022 when the U.S. and Western nations, froze and seized and alienated the Russians from the banking system, is when the world woke up and said, whoa, this could happen to me too, and we need some protection against that. And I think ever since we've seen a strong demand, not only in the metals, but in really physical metal. And that's a trend that's continued. And as we continue into a world where cold wars go to hot wars, as currency wars move into trade wars, and as trade wars move into hot wars, people are trying to get their hands on that metal, and moving metal and getting physical delivery. When you think about how the paper market works, and how many paper claims are on 1 ounce, and how much volume transacts. We were at a point recently where in one trading day, we were overturning an entire year of mine supply in one day. That is all speculation. But when those who really want their metal, we're starting to see that price discovery.
That's just an incredible statistic. Of course, I completely hear your argument of there being a premium on physical. You could also make an argument that there's a bifurcation between East versus West. Of course, in the East, in China, they use a lot of silver for those industrial applications. Is it fair to say that geopolitics also plays a significant role? Like you outlined earlier, you need to have your hands on that physical supply, and it's harder to get.
Well, I just believe there's a sort of an ideological difference from the ancient world and the modern world. And you look at how cultures in China, India, going to Japan, Southeast Asia, how they view the metal. And they just, there's a different attitude towards the metal than there is in the West. I could go down here in the streets of Vancouver, and I could have a gold coin and a Starbucks gift card. And that Starbucks gift card is going to be a lot more coveted than that gold coin. People just don't understand what this means. And it's because we haven't gone through a moment in history. Now, you don't have to go as far east as China or India. You can go to Germany. You can go to Switzerland. You can go throughout Europe, where they experienced people that are still alive today. You don't have to go further than Ukraine, and how that currency has been devalued relative to gold in the last 10 years. And so certain pockets of the world, people that are suffering today in Venezuela, they get it. Fortunately or unfortunately, here in the West, we haven't gone through a major crisis for at least 100 years. The last time gold played a significant role in the banking system was prior to the Great Depression. And again, what we had here is we had the governments, who a lot of people think are there to protect you and make good decisions for you. The government, made it illegal to own gold, and once they extracted as much gold as they could for the public, they revalued it at 50% higher. So it's, people need to be their own central banks. People need to protect themselves. People need to be prudent. And, gold is a wonderful saving instrument, as is silver. And just, like a lot of the greats in our sector talk about, just pray you never actually need it. And we're in an environment right now where you need it, and that's why the price has gone from $1,000 in 2016 to $5,500. All the reasons that led for a 5.5 times increase in the value of gold are still in play. At the end of the day, the sovereigns are still broke. They have no way out, and their reaction to their challenges is lower interest rates and quantitative easing. and my big concern moving forward here is, As the economy worsens and as we get into an evident recession, we are going to see rates get lowered, and we are going to see easy money policy. And I think that could be a catalyst for gold to go to initially 6,000, but ultimately, I could see a place where we're see $8,000 or $9,000 gold, and in that environment, what is that going to do to the price of silver? And that's why I think we're in the midst of a correction right now. We had a really strong move in 2025 that took us from $25 to $115. We are going through a correction right now, but ultimately, in an environment where gold is heading 2 or 3 times higher, silver is going to do very, very well in that environment, and it wouldn't shock me if we got to $150 an ounce and maybe beyond.
Incredibly interesting trail that you're opening up here, Shawn, on gold, and I would love to dive a bit deeper into that in just a second. One last follow-up question on silver. Of course, we're seeing that incredible premium in Shanghai, currently about $14 to $15 an ounce. Is it also fair to say, or are we seeing significant movements of silver from the west towards the east?
I think metal's moving in many directions. I think a lot of metal has moved to the U.S. Since Mr. Trump has come into power for a whole host of reasons, including tariffs, and also a realization. I'm getting, my phone is ringing now, and it hasn't really rung since 2010. And a lot of very, very wealthy U.S.-based investors are calling up, and they see what's happening. They see, what's happening, in the streets of Minnesota or throughout the country. They see, their once great cities that are now being boarded up, and they see the tent cities, and they're concerned. And, the U.S. population already has their guns, but what they don't have is they don't have their gold. And so a lot of U.S. investors that have experienced one of the greatest stock market advances in history, from the lows of 2008, from the bottom in the spring of 2009, the stock market, the S&P, NASDAQ, Dow Jones, real estate, art, anything hard, all hard assets have really done very, very well. And the only things that have really lagged is the commodities. The commodities have been unloved for a whole host of reasons. We had Robert Friedland in the White House in the last couple of days telling the president about how we need real things. We want to live in this modern world. Everything is either grown or it's mined, and we've been in an environment in the West where that has not been appreciated. It has in the East. China has spent the last 2 decades securing farmland and resources globally. And the Trump administration in the last 12 months has taken some major unprecedented efforts, including declaring hundreds of billions of dollars of direct investment into miners through equity and debt. And what the U.S. is really doing is playing catch up. They're behind the 8 ball. And whether it's gold and silver, whether it's critical minerals, rare earths, energy, there is a race that is occurring right now. There's a new race. We had the arms race in the past. This is a commodity race, and a lot of the great speculators in our business have talked about the ascent of man. As the population grows, there's more and more demand for commodities, and technology and innovation has played a great role in allowing us to maximize things like food production and energy maximization. But at the end of the day, we are so far behind. And there's about 7 billion people on this planet, whether they're in South America, Africa, Southeast Asia, that want to live like you and I live. And that's going to require a lot of copper. And the reason gold and silver are relevant is all the governments are broke. And the current system that we're under needs to go through some type of revitalization. Some call it a reset. And gold and silver will get you through to the other side in a safe manner, preserving your purchasing power.
With gold trading at new all-time highs, gold producers are printing money. And this means that for the first time in years, money is beginning to flow into exploration. This is a trend that we at Palisades Gold Corp have long anticipated, which is why we spent the last decade assembling the largest junior-held mineral claim package in the United States through our subsidiary Made in America Gold Corp. Made in America Gold Corp holds over 700 square kilometers of prospective ground, located exclusively within America's most prolific gold mining trend, the Battle Mountain Eureka Trend. Made in America's properties are nestled amongst several of Nevada's largest gold mines and resources, making it highly prospective for a potential discovery. To find out more, visit palisades.ca and join us on our mission to make Nevada's next multi-million ounce gold discovery. Now, back to the show. Definitely great points there, Shawn. Everything is either grown or mined, definitely. And of course, gold is a safe haven asset that can get you on the other side of that potential reset that you're talking about. What you mentioned earlier was if we were to tip into a recession, we might see rates going down a bit or significantly down to zero. Do rates even matter currently when the US is already running a deficit of 6, 7, 8 trillion a year on a economy that's doing tens of trillions a year in GDP?
Well, I think the simple reason that rates matter is, the big knock on gold is gold has no yield. So we were in an environment where rates were rising. And in that environment, typically, historically, precious metals would be sold down. What was really interesting was despite a strong dollar and despite rates rising, gold and silver prices were elevated. So I think that they are going to have a really positive impact because the case to own treasuries is going to go down if rates go lower. So I do think that direct correlation between lower rates and higher metal prices is real. And if you are looking to protect large sums of wealth, you're going to go. You'll be more incentivized to do that in precious metals. Whereas if you look historically, if we go back to one of the last great precious metal bull markets, which ended in 1980. It was on the back of really brave central bank policy. Paul Volcker aggressively raised interest rates in the early 1980s, which really saved the dollar and really was the end of that precious metals bull market. So I think something like that could curb gold's ascent. The challenge, though, unlike 1980, where the U.S. debt was sub 1 trillion, today with north of 35 trillion of debt, and then if you factor in the unfunded liabilities, Social Security, Medicare, you're looking at a number that's north of 100 trillion. How do you service that? I think I can't remember the exact percentage of interest that now makes up the budget, but it's significant. It's a significant line item that rivals defense.
Yeah, definitely. And of course, cutting on the short end of the curve doesn't necessarily mean that the long end needs to go down as well. And interest, like you outlined earlier, is now a larger part of the budget than defenses already. You mentioned earlier a potential financial reset, and I would love to dive a bit deeper into how that potentially could look like if we look at historical parallels, for example. Do you think, Shawn, that a potential remonetization or revaluation of precious metals like gold and silver could be in the cards?
Oh, listen, I'm just a simple junior mining CEO, so I'm not going to pretend to understand, very, very complicated agreements and things like that have occurred in the past, like Bretton Woods and other significant monetary events that have changed how we view reserve currencies. But I think simply put, all fiat currencies die. And, so it would not surprise me if the purchasing power of the US dollar continued to erode over time. And at some point, you reach what is referred to as the Minsky moment, where you go past the point of no return, and a reset is in order. So I'm not going to pretend to understand how the world is going to transact, but could gold play a role in it has for 5,000 years, and is universally recognized as a wealth preservation tool. Gold is money. Everything else is debt. And so it is universally recognized, whether you're in China, whether you're in the United States, throughout Europe. Wars have been fought over it. And I think gold could play a role. What that exactly looks like, I'll leave that to experts like Frank Giustra and others to explain.
All right. I would love to dive into junior mining exactly your expertise, of course. You recently merged as equals, I believe, Dolly Varden together with Contango Ore. So I would love to shortly talk about the strategic rationale behind that before we talk about the state of junior mining currently.
I've been running a silver company called Dolly Varden for the last 6 years. And what Dolly Varden was a past-producing, rich set of silver mines in northwest British Columbia in Canada. And we had done a successful job of bringing a large amount of capital to the company. So we raised about $185 million. And we raised the money with some very, very knowledgeable, successful silver investors, people like Eric Sprott, institutions like Fidelity, and mining companies like Hecla. And so some of the savviest investors in silver mining and in silver investing are our largest shareholders. And then we went out and we secured a very, very large land position in a very prospective area. So we picked up a total of 5 past producing silver mines, 100,000 hectares of ground, and then we deployed that money with scientists to try to expand, extend, and make new discoveries. So we built up a significant mineral inventory of high-grade silver and gold. And we found ourselves at a moment where, when we started this journey, silver was $16. And as the price has gone to $116, we made a decision that we are now incentivized to develop our project. And so now, how do we do that? We don't have cash flow. We don't have a team that can move the project forward through permitting, construction. And so I came across one of the legends in our business, a gentleman by the name of Rick Van Nieuwenhuizen. And Rick has been advancing projects in Alaska, which neighbors Northwest BC, and he's been successfully doing that for decades, starting with Placer Dome on a global basis, and then more Alaska-centric, starting in 1999 with a company he started called Nova Gold, which Nova Gold is advancing a 40 million ounce Alaska deposit called Donlin. He was also the CEO of Trilogy, which is working up in the Ambler district that has the Arctic deposit. And so both companies are very successful. Nova Gold is a $6 billion company. It was started from inception. Trilogy today is a $1 billion market cap, and it has brought in one of the first government investments. The U.S. government is a 10% shareholder in the company. And so Rick's company, Contango Ore, is producing, and in 2025 they made $102 million free cash flow, and that was with average gold prices at less than $4,000. So I suspect there's an even greater opportunity going forward, not only with these higher prices, but as the company brings in other projects. So the company is currently producing from the Manh Choh deposit. It's contributing 60,000 ounces a year. but they're drilling and advancing another past-producing gold mine called Lucky Shot, and Lucky Shot should be into production in 2028, where the production profile will go from 60,000 ounces to 100,000 ounces, and then they have a third project that will contribute when it's in production another 100,000 ounces a year. So Contango has $100 million in the bank. They've got $100 million of cash flow. These are all US dollars, and they have a pipeline to go from 60,000 ounces, which they're currently at, to 200. So it's a great business. And so by merging, I'm leveraging their cash flow and their expertise to help me develop the silver property. And the silver should contribute between 5 and 6 million ounces a year of silver equivalent, so silver and gold. And so what that creates is it creates a very nice business that is in North America, that's high grade, giving investors exposure to both silver and gold. The only other business that's quite like it is a company that's valued at $20 billion, which is a company called Hecla. And so that's what we're doing. Just some important dates here. March 17th is when our shareholders will vote for the transaction, and then the merger should be complete by the end of March.
Thank you for outlining that, Shawn. And of course, when we see the bull market in precious metals continue, we should see also M&A activity pick up. In previous cycles, not everything on that M&A activity front has always been shareholder accretive, sometimes a bit shareholder destructive. Of course, you're doing this merger as a merger of equals. Is that a more safe model than acquiring another because it allows you to not overpay for them?
Well, look, I don't want to sell out of the company here. I think that based on, like, Dolly Varden has a very special project. It's very, very rare to outline 100 million ounces of silver in a safe mining jurisdiction at really good grade. It's next to impossible to replicate. Most of the silver, as I mentioned earlier, most of the primary silver mines, you got to go to places like Bolivia, Peru, Mexico. So to have what we have here in Canada is very, very unique. And if we were to sell the company, sure, maybe we'd get a 30, 40, 50% premium. But then we're going to be in a much larger entity, and that larger entity going from 20 billion to 40 billion versus, the Contango Dolly merger going from $1 billion to 5 or 10, I think there's more upside. So the reason I like the merger of equals is we don't get diluted out. We're 50% owners. We're getting exposure to a lot of high-grade gold in a safe jurisdiction. So if you look at all the attributes, it was the right deal. It's a company I want to own, and we can still grow. Because I think despite the fact that it's pretty evident we aren't in the first inning of the bull market, we're far away from the last. And so it's time to continue to grow and appreciate as the world is, precious metals are still like dramatically underowned from a historical context. Less than half of 1% of all assets are precious metal centric. So I think as the world looks to get some insurance, I mentioned the 1920s and the Great Depression. If you had allocated 10% of your portfolio to home stake mining, you would have got through the worst stock market crash and depression in the world's history with just a 10% weighting to home stake mining. And so I think the lesson for me in that, and again, I'm a lot more than 10% of my net worth is allocated to precious metals, but I think that, if the world goes from less than half of 1% to even 1% or 2%, let alone 10%, I think you're going to see the gold. You could see the gold price at $20,000 if the world made that move. And I think that move is happening.
Far from the last innings in this bull market. Shawn, what is the state currently, if we look at the wider mining complex, if you look outside of the junior market, but also inside junior market, How are we looking at M&A currently? Are we seeing enough of it? Too much of it?
People, it's funny, I talked to a stockbroker this morning. I guess that I can't use that term anymore, investment advisor. And the gentleman said to me, he goes, the market's over. The El Dorado Foran deal, M&A's going crazy. It's the top of the market. And I would say, no, you're way off. What you have to look at is we went through a period. Like if you go back to the end of the last bull market, which was around 2011, okay, so that was 15 years ago. So what has occurred in the last 15 years? And if you really study it, the large companies, Barrick and Randgold merged, Newmont and Goldcorp, and then you had Newmont, Newcrest. What you had is you had these mega mergers, and essentially you have no breadth at the mid-tier category. So there will not be an M&A flurry for a long time because we just don't have the number of companies that we've historically had. We have these a dearth of depressed junior miners that are pre-resource. You have a handful of senior producers here that are exceeding $100 billion valuation, companies like Agnico Eagle, and then you've got this huge vacuum. And I think the big opportunity and why this market is very, very different from previous bull markets is companies are being formed. There was the Hemlo company that was it was an asset that was purchased out of Barrick that's created a new mid-tier producer. What Contango and Dolly Varden are doing by coming together is filling that void and creating a new mid-tier producer. So it's a very different style of M&A, and as companies outgrow projects, as that large producer who needs a 500,000 ounce, project on an annual basis, how companies define what a tier one asset changes as they grow, and there's an opportunity for those projects to become non-core. So it's a very, very complicated discussion, and I think we're seeing a deal here and a deal there. We're not seeing the flurry. What we have seen, though, at the end of 2025 is we saw a flurry of financing activity, which is a really good sign. But again, from a historical context, if you go back to 2010, 2011, we're way off the numbers. And if you think about how much we've debased the currency, just going back to 2020, like during COVID, we increased the money supply by over 25%. So when I compare $2010 to $2025, it's you need to adjust it for inflation. We're not even getting back to the same nominal levels. So I think it's early innings. The game started, but it's early innings. We've got a long way to go, and the world's awash in money, and money being thrown at the sector does not translate into success, discovery. What you should be focused on is what are the production levels? Is Barrick producing more gold today than they were 25 years ago? And the answer is no. And so we've seen peak silver, we've seen peak gold, and now we're in an environment here where the only way to grow is M&A.
Some really interesting points there, Shawn. And as we head into the next few innings, how should one think about volatility in the precious metal sector, but especially for miners, as we again head into those next few innings?
Well, look, if volatility scares you or is a trigger, you're in the wrong business. This is the most volatile market in the world, and it's what makes it so challenging. It also is what makes it so rewarding. But the great thing, like I dumb down bear markets to three phases. You know, the first phase is nobody believes. The last phase is everybody's a genius, right? And we're in this middle phase right now where the question is, we're asking ourselves is this real? And in that phase of stage two, the corrections get bought quickly. And this is the longest and the strongest and the most rewarding phase of the market. The challenge with everybody's a genius phase is, yes, you see the greatest returns quickly, but they don't last long. And if you're investing in that cycle, it's very, very dangerous. So I take the approach where I come in very early, I go overweight, and then I might even be exiting positions before we even get to the third phase, because it's important to leave the party before the lights are turned on. So I just think for anybody who is looking to participate, you got to ask yourself, number one, what kind of exposure do you have? And where do you want exposure? What is your risk appetite? These are a lot of personal questions based on everybody's own financial situation. But for me, I've been positioned in gold. I first got into gold in 2004. I exited the gold market in 2011. I came back to it in 2014. I came back to silver in 2018. I started investing in copper a few years ago. I'm very bullish on copper today. I think that the type of move we've seen in silver, I think that type of upside is in store for the copper stocks. But I also think that because of the recession and because of a potential reset or because of a potential depression, my biggest positions are still gold and silver. But I do believe in the electrification of the world, and I do believe in copper's role in getting us there.
Shawn, thank you so much for your time and your insights today. Tremendously appreciate it.
Well, thank you for having me on.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.